How one-person software businesses actually make money. We break down the economics hype videos leave out, revenue streams, hidden costs, and realistic operator constraints for solo SaaS. Illustrative estimates only, not financial, legal, tax, or investment advice. One-person software businesses are typically small SaaS products or tools built and operated by a single founder, sometimes with contractors, serving a narrow customer segment well enough that support and infrastructure stay manageable solo. Unlike VC-backed SaaS, growth is often deliberately slow and profit-focused rather than growth at all costs. Solo SaaS products typically cluster around a narrow workflow problem for a specific professional audience, invoicing for freelance photographers, scheduling for boutique gyms, a Chrome extension for a specific research task, rather than competing as a general-purpose platform. The narrowness is deliberate. It keeps support volume and edge case complexity low enough for one person to handle. Unlike VC-backed SaaS, which is built to grow the customer base as fast as possible even at a loss, solo SaaS is typically built to be profitable from an early stage since the founder has no outside capital cushion to burn through. This changes almost every decision. Pricing tends to be set higher relative to feature count, and growth channels favor low-cost, compounding tactics like SEO and community presence over paid acquisition. Founder time is the binding constraint on almost every part of the business. Development, support, marketing, and sales all compete for the same finite hours. Many solo SaaS founders eventually hire a single contractor for customer support specifically because support tickets, unlike development work, cannot be batched or deferred without damaging retention. Before evaluating income potential, identify who pays, for what outcome, and why they choose this provider over alternatives. Revenue is subscription-based, usually $10-200/month per customer depending on the tool's value. Illustrative examples publicly discussed by indie founders show solo SaaS products ranging from a few $100s to $50,000 plus in monthly recurring revenue. Though the median solo operator earns far less, many stay in the $1,000 to $10,000 MRR range for years. Expanding within existing accounts often matters more than new customer acquisition. Public MRR figures shared by indie founders on platforms like Indie Hackers skew heavily toward outliers. A founder posting $50,000 MRR is newsworthy precisely because it's rare, while the much larger population of solo SaaS products stuck at $1,000 to $10,000 MRR for years rarely gets featured, creating a survivorship-biased picture of typical outcomes. Expansion revenue, upgrading existing customers to higher tiers or usage-based add-ons, is frequently a bigger long-term lever than new customer acquisition for solo operators, since a founder can typically support far more existing accounts than they can actively sell to new ones. A product priced with clear tier upgrades built in from day one captures this without requiring extra sales effort. Pricing below the market's willingness to pay is one of the most common ceiling capping mistakes technical founders make. A $10 per month tool competing with a genuinely more valuable $49 per month alternative may need the same support effort per customer, meaning the underpriced version requires roughly 5 times the customer count to reach equivalent revenue. Illustrative math. A founder converting even a small fraction of an existing audience or community, say 200 people at $29 per month from a technical newsletter of 5,000 subscribers, reaches nearly $70,000 in annual recurring revenue without any paid marketing, which is why founders with an existing audience have a structural advantage over cold start builders. Compare gross revenue to net cash flow, they are not the same. Startup cost range, Illustrative $0 to $10,000, mostly time, some tooling/infra costs. Costs are dominated by the founder's time. Unpaid or opportunity cost, plus hosting, payment processing, roughly 3% per transaction, and customer support tools. Illustrative monthly infrastructure costs for a small SaaS, $50-500 depending on scale. Marketing costs vary. Many solo founders rely on content, SEO, or community rather than paid ads due to limited budgets and thin margins on low-priced products. Margin pressure, very high gross margin, 80-90% plus, net margin limited by founder time capacity. Owner labor is frequently the largest hidden cost. Value your time at a realistic hourly rate. Infrastructure costs for a small SaaS product are genuinely low, commonly $50 to $500 monthly for hosting, database, and email delivery at moderate scale, which is part of why solo SaaS gross margins routinely exceed 80%. The real cost is founder opportunity cost, months or years of unpaid development before the product earns enough to replace even part-time income. Payment processing fees, roughly 3% per transaction, and customer support tooling add modest recurring costs, but the more consequential cost is the time spent on support as the customer base grows. A founder who spends 10 hours weekly on support has effectively converted that time into a fixed cost that scales with customer count, unlike infrastructure, which scales far more slowly. Customer acquisition cost is often near zero for founders using content, SEO, or community engagement, but that low cash cost hides a large time cost. Content-based acquisition commonly takes 6 months to a year to compound into meaningful signups, during which the founder earns effectively nothing from marketing effort. Common failures include building a product nobody urgently needs, underpricing, which caps the revenue ceiling even with a decent customer count, founder burnout from being the sole developer, support agent, and salesperson, and choosing overly competitive categories dominated by well-funded incumbents. Public solo founder success stories rarely show the abandoned products that preceded the eventual winner. Key failure points: weak product market fit, underpricing, founder burnout, crowded category. Hype content optimizes for clicks, operators optimize for contribution margin and cash runway. Building a technically impressive product nobody urgently needs is the most cited solo SaaS failure. Technical founders frequently overinvest in code quality and feature completeness before validating that a paying customer segment actually exists and is currently paying for a worse alternative. Underpricing caps the revenue ceiling in a way that's hard to fix later. Raising prices on an existing customer base risks churn and negative reviews, so founders who start too cheap often stay underpriced for years rather than face the discomfort of a price increase conversation. Founder burnout is a structural risk unique to solo operation. There is no one to cover support during a vacation, no co-founder to share the emotional weight of a bad month, and no team to absorb a sudden spike in churn or a critical bug. Many solo SaaS products don't fail from bad economics, they fail from the founder quietly walking away. Entering an overly competitive category dominated by well-funded incumbents with dedicated sales and marketing teams is a common early mistake. Solo founders compete better in categories too small or too specific for a venture-backed company to bother entering. Verdict on solo SaaS: good for technical founders with a specific problem and existing audience/network, hard without dev skills. Startup cost: low scalability, medium-high automation, medium risk, medium beginner, good for technical operators. Verdict: legitimate but slow grinding path requiring real product-market fit. Do the spreadsheet for your market. Run a small test before scaling. Solo SaaS is a legitimate, high-margin business model for technical founders with a genuine niche problem and either an existing audience or patience for a slow organic ramp. It is not the fast, passive path the best case public. Our screenshots suggest. Before building, find 10 people who currently pay for a worse solution to the same problem. If they don't exist, no amount of clean code or clever marketing will manufacture demand that isn't there. Subscribe to Money Machines for more hype versus reality breakdowns. Educational content only. Illustrative estimates. Not financial, legal, tax, or investment advice.